glad first to announce that this is the first segment in the Deep Tech track run in collaboration with Adara Ventures. So if you're interested in cybersecurity, big data, and AI, join them later at the playground stage. Okay, so I am thrilled to introduce our first keynote speaker of the day. A man regarded as Britain's most successful technology serial entrepreneur. And this is just the beginning. He holds a PhD in adaptive pattern recognition from Cambridge University, where he invented a technology in which he later based his company, Autonomy. Autonomy became one of the UK's most successful technology companies in the FTSE 100 and was acquired by HP for $11 billion in 2011. I repeat, billions with B. He is a UK government scientific advisor and founder of Invoke Capital, a different type of technology investor. In his role as a leader, he said, "If you really want to understand things, read your Shakespeare, because it's about people, their loves, their hates, their greeds, their fears." Well, with such a background, no one better than him to talk about building and backing deep tech companies from inception to IPO. It is a real pleasure and an honor to introduce on this stage Dr. Mike Lynch. Welcome, Mike. Welcome. I left it on.
Well, welcome everyone. I'm afraid after all of that relaxation, it's now time to wake up. Building and backing deep tech, you've got to go into it with your eyes open, I'm afraid. It's also quite stressful, so you can probably do that session afterwards. What do we mean by deep tech? Well, deep tech is where there's a fundamental technology. So now that technology affects everything, e-commerce, how you buy your shoes, whatever, we need to differentiate between businesses which are enabled by tech and those which are fundamentally driven by some advance in technology, and that's what we mean by deep tech. And my background is one of both investing and in building a series of deep tech businesses. It's an area we're very, very good at in Europe. We tend to produce great tech businesses, and one of the things I'm going to talk about is how we turn those into very, very large businesses. But why do deep tech? Well, first of all, it has the ability to completely change the world. Some of the things that a piece of technology will allow you to do can make the world a much better place, a much different place. If you want to look at it financially, it's an area of business where often these businesses will have 90% gross margin, 40% operating margin, and they can grow exponentially, and they can grow very, very rapidly. So get it right, and it's really interesting. What I do now is a $1 billion fund, and we invest in primarily European deep tech. Some of these businesses you'll be familiar with. Darktrace, 3 years old, already got 250 million in bookings, and that's about 900 million valuation. Sophia is the leader in market share in genetic testing, and that's exponential growth. Luminance is also market share leader for helping lawyers by using AI and machine learning. So these are all examples of fundamental tech businesses. Now, almost everyone that comes to a pitch to an investor tries to make out that there's some kind of different technology in there. 90% of the time, that's just not true. That's not to say they're not good businesses or they're not investable, but there is no actual fundamental deep tech. And so what you need to be looking for if you're a deep tech investor is what's really different. And one of the interesting things at the moment is every single pitch I see talks about machine learning. Now, machine learning is actually a very difficult subject. It requires very highly qualified people to make it work. And so the reality is that this is a sticker that's been put onto investments because people are saying that that's a differentiation, or indeed in some really worrying cases where there's a gap in their product, they're going to fix it by machine learning. But what it shows is, as an investor, you have to be prepared to really get under the hood and understand what the idea is you're looking at. So the whole thing that's key in deep tech investing is, what is the technology? And here, if you are someone starting a business, you need to be really sure that the technology that you think you have actually is an advance over what's out there. Because remember, what you see in the marketplace is probably 3 or 4 years behind what other people are working on. So the first thing is to really understand what your technology is. The second thing is it actually useful? A lot of the technology we see, there is no use for it. It's beautiful, but it's not useful. And so what is the actual problem that it solves? And then the last one, and this is the key one for both the investor and someone working in deep tech, is it scalable? All of the benefit of deep tech comes when you get a scalability in the business. So that means that when you get 2 customers, it's not twice as much effort to actually service them. And a good test of that is whether a human being is involved each time you get more customers. If the number of people you employ scales with the number of customers, then you will not get that gross margin, you'll not get that operating margin, and it will be very hard to grow that business. And so one of the things you have to look out for is, does the tech actually hit that scalability test? And a lot of young entrepreneurs don't really understand that, and so you get ideas brought where they haven't looked for that. As an investor, the key thing to understand is the demo is irrelevant. If anyone is any good at this stuff, the demo will be amazing, especially in areas like machine learning. But that's actually not the issue. The issue is not how good the demo is. So I've seen people get suckered into making useless investments in AR because they see an augmented reality demo. It blows your mind. And what they don't realize is what else is out there, what the limitations are. Or another one was a 3D television. So be very, very aware of the demo. But also, technology that is going to make money has to work in the real world with real customers. So for example, someone's showing you a piece of technology in a lab that has to work in the outside world with people. And what you should be able to do is test these things. So I'll give you a very simple example. If you have, I had some people come in and they had a sort of more advanced version of Shazam. Rather than listening to music, you could just sing to it, and it would spot the tune. Now, the first question on that is whether there's a market, but putting that aside, the people that came in were actually choral scholars, and they sang beautifully, and the machine recognized the tune. The vital thing to do was to go and get our receptionist and get her in to do some singing, which was appallingly bad, but it represented the market, and of course the machine didn't work. And time again, the important thing is, as an investor, you have to do that real-world test if it's supposed to work. And we're going to see a lot of money lost on machine learning applications because people got suckered by the demo. What do you actually need to be successful in deep tech? Well, the important thing here is always take a gun to a knife fight. People who do deep tech, they're not branding experts, they're not experts in consumer, they're experts in technology. So the technology has to be 10 times better. So if it's a cost reduction, 10 times cheaper. If it's speed, 10 times faster. And the reason for that is, by the time you get that product to market, it will be 3 times better, because not everyone else stays still. So another great thing that you see in deep tech with entrepreneurs' investment is starting something when the advantage is not big enough. There's an assumption the rest of the world stays still, and it will take you time to get that product out. Always have an unfair advantage in your product in deep tech. Always take that gun to the knife fight. What about people? Well, in deep tech, you'll often have an amazing technical person, perhaps an engineer, who has created the technology. And the first thing to understand is that that person probably will not have all the skills needed to make the business successful. And what happens is entrepreneurs group together. They surround themselves with people that are like themselves. So you get a little group of 5 engineers, or you get a group of 5 MBAs. And actually, what you want is people that are different to each other, that have different skills. So for example, at Cambridge, when I teach the MBA class, they come up at the end in little groups of 5, and they tell me their great idea. And I tell them, a mile down the road is the engineering department. There are people in there doing amazing things. They have real technology and ideas. You have a lot of knowledge about building a business. Swap. Don't come to me as a group of 5 MBAs, but swap. Put different skills together. The other thing is look out for the people that are uninvestable. I went to see a beautiful DNA sequencing company. I was all ready to write a big check. And then when I met them and they told me about how they were only going to deliver a perfect product, I realized these people will never deliver a product. And so it's very, very important that the people have the right approach and that you can then either put together or get the right group of people that are not the same. You want people who are as diverse as possible. The next thing in a small deep tech business is there's a lot of mythology about doing it properly. And the important thing about technology business is you have one asset which is absolutely crucial, and that is time. It's not money. There's actually a lot of money out there if the technology is very good that you're doing. But what you don't have any ability to save is time. And if you start doing the wrong things and not focusing, you lose that advantage. And we see this all the time in the Valley, where you get companies that raise 100 million, 200 million, 300 million, 400 million, and then the product never comes out. And that's because it's very hard to stay focused when you're spending $400 million. What you've got to do is work out what really matters. I've been to tech companies where 100 employees, 10 people in HR. And you say to them, why have you got 10 people in HR? And they'll come back with an undeniable platitude, because people are our asset. Well, they are, but if you've got 10 people in HR, those people are going to be doing the wrong thing. And so prepare to be brave, deal with problems as they come. If there's 4 founders in a tech business, if you have to spend £50,000 on your contracts between each of you, you shouldn't be going into business with those people. So doing things properly, to put it in inverted commas, can often be a big mistake, because what you need to be doing is what matters. Vision and culture. Tech businesses have a cause. In order to make technology that no one else has made, you have to do remarkable, exceptional things. And that means people have to work together in remarkable and exceptional ways. And they do that by having a vision of what they're doing and why they're doing it. Part of that can also be a vision of who they hate. Many of the great technology businesses in the world wouldn't have started if Microsoft wasn't already there. A number of times I've heard engineers be really angry about something Microsoft's done and decide to do something. Who do you hate, and why are you going to change the world? And then the culture that does not accept mediocrity. If you've got an employee and they're not pulling the weight with the team and they don't want to be part of that vision, there's nothing wrong with them going and working somewhere else. You want the people that really want to make that vision happen. And that might not be a comfortable environment for someone that wants 9 to 5. And there's nothing wrong in making that happen. On the other side of the equation, the people that make it happen, as an investor, you must reward. Whether the person is an entry-level engineer, the receptionist, or one of your geniuses, if they are on that mission and they are really putting in that remarkable work, you must reward them. And so options are about being specific to people, not about plans. And that's how you create that culture. Let's talk about funding. One of the biggest problems of being a deep tech investor is getting crushed in later rounds. So you go in, you do all the work, you're an angel, you find an amazing business. The business takes a little longer to get its product ready. You have to raise more money. Someone comes in and they crush the early rounds. So one of the important things in order to make a return in this area is to either have yourself resources to go all the way through, or to be working with someone who does. Because that way, if someone tries to come in and on a subsequent round crush you, your inability to say, no, we don't need your money, we can carry on anyway, and then the conversation becomes a lot more sensible. But this is one of the things that destroys early stage investing returns. So make sure you've dealt with it up front. Don't assume it will sort itself out. There is, contrary to what people say, a lot of money out there for startups now. The issue is coming when the companies get bigger. And so what we're seeing is some of our great businesses being sold off at 100 million, at the point where they could have gone on to be $10 billion businesses because someone comes and makes them an offer. And the way we need to fix that is to make the European stock markets work better so that these businesses can keep growing. And what we see is a lot of examples now of European technology helping create $10 billion US businesses. We need now to be ambitious and move on to the next level. As an investor, one of the things you see sometimes is people believing their own PR. The most important thing you can do in deep tech is have a staircase in your business. What you do not want to do is try and maximize the valuation of each round. In deep tech, when you get it right, you will knock the ball out of the park. A few percent dilution here or there doesn't matter, but what's most important is that you have the right investors on the right terms. So the way in which you will get the maximum valuation is by going with an investor who will demand ratchets and all sorts of things that mean they start to own the company as soon as there's a complication. That destroys companies. So do not believe your own PR. We've seen a whole series of companies destroyed because they were desperate to get unicorn status, and they did deals which technically made them unicorns, but meant they were unfundable. And those companies are now dying. So be realistic. This is the hungry wolf, mighty, magnificent predator. When it's out there, it goes and it brings down elk, and it lives well. But when times get bad, that thing will eat lichen. And the important point here is there is nothing wrong in a company realizing that something's taking longer or not working and doing some kind of pivot. Every business I've ever seen has done a pivot. Okay, and the reason it does a pivot is it goes and it interacts with customers, and it learns from the customers that what they wanted was slightly different, or what they're prepared to give you money for now is a slight addition to what you're doing. So the most important thing is never ever invest in a deep tech company that says it's not going to have a product for more than 6 months. Now that's a big shock to people because they think that you should be investing for the long term. But if what they're doing cannot produce some kind of product in 6 months, run. Because it may not be the main product, but it shows that they're thinking about customers and they will learn from those customers. Marketing. Deep tech generally starts with engineers or technology people or biotechnologists. And they make the best mousetrap. And if they make the best mousetrap, the world should beat the path to their door. And it doesn't. Because what matters is marketing. And in Europe particularly, we are very weak in technology marketing. You have to have both the best product and the best marketing to succeed. Similarly, sales. Some of the companies that we've invested in, when we invested in them, had their budgets, they didn't have hiring any salespeople. Because technical people don't understand a lot of them selling. They don't like it. It's a very difficult process. And some of the best salespeople are very different to them. But the most important thing in your technology business is the first conversation in every board meeting is about selling, because you've got to get them to understand that is how we move forward, that's how we get critical mass, that's how we get customers, that's how we get feedback on the product. Competition. Make sure you're carrying that gun to a knife fight, but don't get drawn into his kind of fight. The competition, the legacy player, has a whole series of advantages. Redefine the game in the way you do. You never want to see a chart in your technology business which is you versus the legacy competitor with tick boxes. Completely change the playing field, reposition things. They are legacy, they are yesterday. What you're doing is about tomorrow, and it's not about being a little bit better, it's about a revolution. Let's talk about exits. So at the moment, there are three basic ways of exiting. One is the IPO, the second is a trade sale, and the third is this bizarre state we have now, which is perennially private, the kind of 20, 30, $50 billion private companies. I'm very worried about that because at the end of the day, there has to be a last investor that has an exit, and I don't see how that continues indefinitely. But that story's still playing out. So let's talk about some of the more traditional ways. Trade sales are a great way to exit if you are really decided that the business has gone as far as it can go at the time. And at the moment, this decision in Europe is being made because of capital structure, not with the businesses. So what we need to do is make sure we've got investors in Europe who will take that $100 million business to be a $10 billion business, and we can do it, and that will be incredibly good for the ecosystem. IPOs. What happens on an IPO is for the first time, the stock can get shorted, the negative story can come into play. So you see this with some of the companies like Snap that have IPO'd and then the public markets have taken the valuation off. And the reason for this is that there's so many complex structures in the private market, for example, these pref shares and ratchets, that although they have one headline valuation, a sophisticated investor knows they're worth a lot different to that headline evaluation. So when you go to the public company, that gets sorted out. It's a bit like trying to dock two spaceships. Unless they're moving at exactly the same rate, you're going to get a pretty violent time. So what you've got to do is make sure that when you're doing an IPO, you start to bring those two together, and then that can be very successful. So to conclude, the journey is fantastic. It's incredibly exciting working in deep tech. You work with people that want to change the world and people that can change the world. We are very, very good at the deep tech in Europe, and now we have a whole series of examples of European deep tech that has managed to get to be multi-billion-dollar businesses. We're seeing the technology move at an amazing rate, deep learning, genetics, all sorts of areas, which means that this is an incredible area of opportunity, both for you as investors and for you as entrepreneurs. Thank you very much.